Want to expand the conversation here? Let's bring in Todd Jablonski, Principal Asset Management CIO of Asset Allocation. Todd, let's just get your take here. It seems like the market isn't convinced that things have calmed down. Where are you on financials right now?
I think financials as an equity sector fall into that risk-on category that we've been sort of shifting away from tactically as we begin to see the U.S. economy slow down. Really, I think equity investors have been over-optimistic for quite a period of time. You've had a base case, I think, baked into investor expectations that you might see some Fed easing maybe towards the back half of this year and maybe into 2024. And I think that hope took equity investors into misguided places. I think a more rational expectation on what we see in terms of earnings growth in the U.S., maybe this year around 1%, and a slowing economy as the Fed's tightened 475 basis points in 1 year, in this cycle, that's meant for a lot of pressure on financials and on risk-seeking equity exposures.
Todd, do you think this at all changes how the Fed is looking at and maybe affect the Fed's decision, not so much tomorrow, but maybe what they could potentially come down with in June?
Well, we expect an additional 25 bip hike coming tomorrow, and that's in keeping, I think, with where the Fed mandate needs to be focused right now, around price stability over financial stability. That tension that the U.S. central bank is facing is really being shared by other central bankers around the world, and we think that those forces are really designed to arrest and should be focused on inflationary forces. Persistent, above expectation inflations is really the more damaging element to the economy. So I think you'll see the Fed continue to lean on arresting that excess demand that's pulling through those price increases.
Todd, well, we've got the regional banks, the sell-off there kind of, leading the declines in the market today. We did get some data that, seems to suggest things are moving in the right direction. We could say it's bad news is good news with the JOLTS report. We saw job openings hitting a 2-year low. I realize, the Fed doesn't just move off of one particular data set, but when you look at what we heard today or what we saw, what does that tell you about just how the Fed's policy is taking hold, at least within the labor market?
At least within the labor market, you are indeed seeing signs of a bit of slowing that I think sort of validates the approach that the Fed's taken in order to, I think, really slow down the pace of economic activity. But I don't know the labor force is really the key variable to be watching. One, labor is a lagging indicator, so it's giving you information on a delay. Two, it's not just about the unemployment, it's about the labor force participation. 7 out of 10 Americans were part of the labor force before COVID pandemic. After the pandemic, it's about 6 out of 10. So even though you're seeing some hiring in labor begin to slow, I think for the recovery side, you're going to have to see a dramatic re-increase in labor force participation. And I think that's the mechanism across the labor market that really leads us forward.
So Todd, given all that, is it time for investors to stay defensive? How should they be allocated?
Well, tactically, as an asset allocator, I think it's wise to look at one's risk appetite and scale back in terms of where investors are reaching for a return. Perhaps an underweight of equities might be advisable as we think about how to tactically shift a multi-asset portfolio, taking that equity exposure down, pushing down your expected levels of risk in favor of more defensive opportunities. In particular, I'd point to core U.S. dollar fixed income as having appeal today. Whether that's treasuries, mortgages, IGC, core fixed income had a very difficult year in the last two calendar episodes. But in 2023, we're up 3.5% through the early going. And I think that you can go back to expecting stability and income from your U.S. core fixed income holdings. That's something that's been missing and could hold appeal tactically to investors today.
Todd, even within equities, you've talked about increasing exposure to outside of the U.S. emerging markets. We heard the IMF overnight coming out with their revisions on growth within Asia, sort of saying that they believe that momentum is starting to pick up, at least with the China reopening. Is that part of your base case here, that things could really start to pick up there, and therefore investors should be allocated a little more outside of the U.S.?
Indeed, I think we're seeing pressure on not only the delivery of U.S. earnings, but also on the strength of the U.S. dollar, which had really buoyed U.S. returns for U.S. investors. But here in 2023, again, as I mentioned, you're looking at 1% maybe earnings growth from U.S. stocks and 13% expected this year from Chinese equities. 15% earnings growth expected in 2024 from Chinese equities. So as you begin to look across the globe and consider the investment set, In China, you have not only positive economic surprise, but negative inflation surprise, coupled with strong fundamental delivery of earnings. That adds up to a more attractive equity package. And so we underweight the U.S. inside of our asset allocation strategies with the preference towards EM. And the complex not only includes the growth trajectory of China, but also good value opportunities across Brazil, Chile, other Latin American economies where from a valuation standpoint, you see opportunities that haven't existed since 2003. So as a basket, EM equities holds appeal, we think, in a balanced approach.
All right, Todd Jablonski, great to have you on here. Principal Asset Management, Chief Investment Officer of Asset Allocation. Thanks so much.